So David Andrews has kindly joined us today to talk to us about how some of the less scrupulous brokers really do rip off their clients and make money at their expense. David Andrews has worked in investment law firms and banks across the world. He has worked for, to name but a few, a leading Sydney law firm, Milestone Stephen Jack, as well as the US law firm, White and Case. Most recently, David has spent the last 8 years at JP Morgan in London in the exotic derivatives cross-asset legal team, where he was recently co-head. That was all before founding his own company, Atom 8. Throughout his career, David has been very keen and maintained a strong interest in foreign exchange and has put a lot of effort into understanding the fundamental, technical, and now business side of the Forex market. Hey David, how are you doing?
Sorry, Ben. How are you doing?
Yeah, very well, thank you. Happy Friday to you.
Happy Friday to you as well.
David, thank you very much for joining us this afternoon.
My pleasure, Rob.
Now, David, let's jump straight to the chase. Can you firstly, it's a bit of a minefield out there with regards to what brokers are what. So can you, first and foremost, introduce us to the different ways brokerages are set up?
Of course. Generally, there are two models. Where the broker, what I call an agency model, where a broker passes your client trade directly into the underlying market, the interbank market. So you put on a buy, then they'll put on a buy to what's called hedge your position. And so in that's the cleanest model because there is no interference, and they simply pass your trade through and you get charged a commission. That's what people call an STP, or a straight through processing model. On the other side of the spectrum, there's a model, a B-book model or a market making model, where the broker is actually effectively taking the other side of the trade. So when you win, the broker loses, and when you lose, the broker wins. Now these are commonly known as market makers, and they those brokers are very common in the UK in the spread betting market. That would predominantly be the model that is used within their setup.
Okay, so a very high chance that people listening will have an account open with a B-book broker for that very reason, where the broker is essentially taking the other side of the trade, which isn't necessarily a bad thing, which we'll talk about later on. But certainly some brokers, some of the more unscrupulous brokers out there, do use certain slightly more covert tactics to ensure that they always win, or the house wins and the client decimates their accounts. Of course, this isn't true of all brokers, but some of them. And I think it's important that we kind of get the inside info on how brokers do it, so that essentially it can empower listeners to really keep their broker accountable. So what, from your understanding of how brokerages work, I mean, what kind of temptations or hidden kind of tactics would brokers use to typically make sure that they win and the client loses?
Certainly. Well, not all. I'll start by saying not all brokers will do all of these things. However, they may have the ability to do so. When the broker is taking the other side of your trade, if you are winning, then they are losing money, in simple terms. So what methods are available for brokers to try and tip the scales in their favor, if you like? One thing that they can do on a dealing desk is widen the spreads. So that means that the price between buying and selling, or getting out of a trade that you're already in, becomes further away from the current price you're seeing on the screen. So it may look like the trade is going against you. That's commonly the experience, even if the underlying interbank market, for example, is in your favor, as you're taking a price directly quoted by the broker and not the underlying market. You are subject to the spread widening. So that's sort of the first way to get you to close out a trade, or if your stop loss, which they have on the screen, is close to the market price or the price they're quoting, the spread widening may have the result of your stop being triggered, and that will take you out of the trade. And when you lose, then the broker would have made money by taking the other side of that trade. And the other alternative method employed is to increase the leverage, either on a portfolio basis for all clients or for individual accounts. So for example, it is your leverage, be it 50 to 1, 100 to 1, 200 to 1, which determines how much you have left in your margin, or how much available margin you have left. If all of a sudden your account moves from leverage of 100 to 1 down to 10 to 1, your use of margin increases tenfold. Now, if you hit a margin call position, it may be the case that it has the same effect as hitting your stop loss, and you might get taken out of the trade, which otherwise you could have maintained, potentially also to a level of profit. So they're the common things which can be used. And so the end result is that the rules can be stacked in the favor of the house, or the broker in this case, and over time, it's probably a fair assumption to say that will reduce your performance or cause you to be an account that loses money when there is no necessary reason for it. You could have been in profit on another broker.
Okay, so is it fair to say there's kind of situations where you're in a trading position, say for example long on cable, which is the pound versus the US dollar, and you're in ultimately what is a winning trade, except the price has come very close to your stop loss, then immediately reverses and goes in your favor, except that the broker's taking you out. They'd rather have their slice of your money rather than giving you a slice of their money, so to say. All right, so that is interesting about how they widen spreads. So why do they do this if the client's already paid this, just to ping you out?
Well, what happened? This comes back to the point about taking the other side of the trade. Brokers make money in several ways. The common ways at the moment are, one, the spread commission, or the dealing volume commission that's paid outside of the spread. They also make a markup on the overnight financing, or the swap, which is the cost of lending you an amount of your trade size overnight. That's the second way to make money. And the third way to make money is the raw profit and loss for taking the other side of a trade. So if a client loses a £1,000 account, which is for which the counterparty is the broker, then the broker makes £1,000. That is by far and away the largest slice of a retail broker's revenue. So that is why there's an incentive to do that, because it's a binary result. Either you win or the broker wins.
Okay, so a lot of people, with regards to the overnight financing fees, certainly in cash daily rolling positions, you won't get this for contracts or futures, but a lot of people are blissfully unaware about their overnight financing fees, which brokers are essentially at liberty just to take a nominal amount of money out of your account overnight, right?
Well, yes, I mean, that summarize. It's the cost of borrowing, or the cost of the financing for holding a 100,000 position overnight. So if you like, you're paying the broker for taking credit risk on you, because if the trade gaps against you and your account goes negative, then it will ultimately be the broker who has to pay the shortfall to the liquidity provider, and if you don't pay them back the shortfall, then they'll be out of pocket. So it's if you like, a credit risk charge that they levy. I think so I don't have a problem with paying swap necessarily. I think it's a question of degree. Sometimes the markups are 0.4, 0.5 of a pip, so they would make a considerable dent in your account if you left trades rolling for a medium-term sort of multi-week or month basis. It could make maybe a 10% difference in your account over the course of a year or more.
Yeah, sure. So, I mean, imagine that if you're up in a trade which lasts, say, 4 months, and you make, say, 10% on that trade, but half of that's gone in overnight financing fees. That's a horrible predicament to be in. So what would your advice be for customers or people who trade to circumvent that and get around that? Would you recommend futures contracts or?
Um, I think I would firstly start by saying, you should be in the market trading, where your expertise is, and you should not, jump around across multiple markets too much. I think you need to specialize in this game. So if it's futures, fine. If it's spot FX or CFDs or physical ETFs or shares, so be it. I think the point is, in whichever market that you are active, that you find out that you search out a competitively priced broker, not only on spreads but also on the overnight financing, if you are likely to hold trades overnight. So I think you need to do your homework to find the right venue for your trading.
Sure. Okay. No, very good. And that's basically, a lot of people forget to do this at the point of like opening up a brokerage account there, usually, myself included back in the day, blinded by the incentives that a lot of brokers give. But you mentioned gapping earlier, David, and I heard one story of one brokerage in particular, one B-book brokerage, who actually, if any of their clients were in a trade and it gapped in favor of the client's position, the client wouldn't make any money, but if it gapped against them, then of course the client will take the full loss. Incredible, huh?
Well, that is, that frequently happens. It's probably, and those types of provisions are probably reflected in the client agreement, but that's not necessarily the way to run a business in a fair sense. I mean, sometimes there's been some discussion in the press from time to time about asymmetric slippage. So where limit orders and or market orders as well, if they're in the favour of the broker, are retained by the broker, but if they're in favour of the client, they're retained by the broker. So you need to be, you need to watch that as well and ask about best execution policies and how slippage is dealt with.
Sure, and I guess a lot of brokers aren't expecting clients to ask those kind of questions. So knowing all this information prior to opening a brokerage account will make you all the stronger. David, it seems quite apparent, certainly from my time in the industry, I've noticed that certain brokerage houses are becoming more and more aggressive in getting their clients to trade. Not necessarily of trade signals, but I mean, I get peppered with emails, certainly from brokerages who I don't even have an account with, encouraging me to have a view on gold, long or short, or have a view on this stock, long or short. Would you say that this is just a process designed just to simply get clients to trade regardless of their ability to actually trade well? So make more money?
Well, I mean, it is. You are correct. It is a form of marketing technique that people use. Potentially that type of campaign could be considered as seeking to attract people with less experience in the markets than other forms of marketing campaigns, potentially. I think the point is that most brokers, at least those regulated onshore in the UK, have an obligation to assess the suitability and appropriateness of trading for any particular client. So they need to do a suitability assessment to make sure that the clients have sufficient knowledge to trade, and then that's a regulatory requirement.
Okay. But how does this sit with other brokerage houses situated abroad, like for example Cyprus or Greece? I get quite often contacted by such brokerage houses. I mean, where does the law sit with foreign brokerages trying to seduce UK or even US clients to come on board their books?
Right. Well, I mean, I'll start with, say, US clients. To take on US clients, you need to be normally regulated as a retail foreign exchange broker in the US, and that's they are domestic US requirements, and they are very strictly adhered to. As regards the marketing to clients onshore in the UK, there are conduct of business rules which talk about the way in which people are marketed to onshore in the UK, be they from brokerages that are in the UK or overseas. So there is a certain minimum standard applied to marketing to UK retail clients. Having said that, not all offshore brokers adhere to those standards. As to what the standards are for a Cypriot broker or a broker in some other jurisdiction, be it Russia or Malta or any other offshore jurisdiction, I don't know what those rules are. They're probably less stringent than the rules on financial promotions in the UK.
And they're not covered by the FSA. Our compensation scheme, for example, for any clients who open up brokerage accounts with overseas companies, so to say. So it's a bit of a risk in its own right, would it be fair to say, David?
I think it comes back to the point about due diligence, but yes, they are risks, and I think individual investors should always make sure that they inform themselves as to the level of any statutory compensation scheme, if any, in the relevant jurisdiction. It's an important point, and it's something that people need to proactively find out about.
Okay, no, I completely agree with that one. But another trend actually moving forward with brokerages, certainly big book brokerages, is to offer free money to clients who deposit a certain amount within their accounts, so that the client has the impression that they've got a lot more money to trade with than they might actually have. Why is this? Is it just a form of making extra rebates on commissions, or to retain them for longer, or both?
Well, I think the basic principle when you see those too good to be true offers is a healthy skepticism, and also there's no such thing as a free lunch. I think a broker is not going to let you blow up your account quickly and then run off with the deposit that you've put in, having made the broker a loss. They're going to make back what they've offered you in commissions, and they won't let you take out money that is causing a loss to the broker. So it's important to understand the terms and conditions attached to these bonuses. I mean, if someone puts in £1,000 into account and a broker says, I'll give you an extra 1,000 to trade with, effectively what they're doing is they're doubling your leverage. So leverage is dangerous in the wrong hands, and if you were given 200 to 1 plus an extra 1,000 or 100% on your deposit, you're actually giving them leverage of not 200 to 1, it's 400 to 1. So 400 to 1 in the hands of an inexperienced trader is highly likely to end up in the account blowing up, and that's more profit to a B-book broker. So I think people need to understand the rationale for these marketing initiatives and make sure that they set out if you like, the pros and the cons, so that the financial promotion, i.e. the no deposit bonus or the free 100% top up, is fair, clear, and not misleading in all circumstances.
Generally, a lot of people read what they want to believe, or believe what they read. So, for example, like they won't be able to withdraw that money which the broker gives them. It's just designed so that even if they risk manage with their accounts, say risking 1% per trade, they'll be risking more than 1% really if they include the broker bonus money, so that the broker will essentially make bigger rebates, is it fair to say, from that?
Well, I mean, the broker will make the commissions on the trade size that you trade. So if you're trading 1% of a £2,000 account as opposed to a £1,000 account, yes, the commissions will be double the size. That's correct.
Okay. No, brilliant. So good to have an awareness for that. I mean, it's an increasing trend in seeing becoming ever more prevalent within the industry, certainly the beaver brokers. Um, Now, one famous case actually happened a couple of years ago, but there was one rather famous broker which actually used to have the requirement for all clients to have their stop loss, their protective stop loss, mandatory for every trade that they place. But now last year I think it was, they sent out an email saying that they're no longer making that stop loss an essential requirement. What are your comments to that, David?
I don't know the reasons for the change in policy. Having a mandatory stop loss will not suit all traders who trade without a stop loss, and if they're successful with that strategy, then that's great. But it's probably a minority of traders. But if the broker's a B-bull broker, requiring people to trade with a stop loss will reduce normally the losses that the brokers, the individual traders incur. So it's probably connected to that, although I can't really comment on the rationale, but I suspect that may be the part of the reason.
Right, so David, we talked about how brokers essentially maximize their profits through various devices which are hidden to the clients who don't read the small print. But such tactics might be viewed as unethical by the clients, but are they actually legal?
I mean, I think there are certain things that are illegal for brokers to do. Then there are certain practices which, whilst not illegal, would probably not make the client very happy if they knew what was going on. So, so I guess you need to break down what's actually occurring. But front running a client, asymmetric slippage, breach of confidentiality, those types of things are not legal or in breach of regulation, depending on the relevant jurisdiction. Other things, just the standard B-book model is permitted for full principles, as if you like the privilege of warehousing risk, which market makers do. So I think that you've got to take a view what you're prepared to accept from your broker, and then again, as I said before, due diligence on the model in which the way the broker is configured and the way they deal with your trades is the best way to reduce those types of risk of unpleasant surprises.
Okay, no, brilliant. So, I mean, how would you actually say that they cover themselves? I mean, would you say that they just mention all this in the small print, like the positive gapping, for example? If it gaps in the client's favor, they don't make any money, but if it gaps against them, they make a loss. I mean, would that be hidden in the small print, would you say? Because I know brokers that do that.
There are, I think there are brokers who do that. And again, you have to be careful if you're talking about asymmetric slippage, which it sounds like there's certainly crossover with what you're talking about there. That should not be done. Having said that, you need to treat stop and limit orders. Have certain characteristics which you need to be aware of. You can get slipped on a stop because it's not a guaranteed position, or an entry, whereas with a limit order it's the same or better price. And if a broker's got, say, a market if touched order, that's a way of getting into a position using a limit order, but also accepting that you can take up to a pre-designated level of slippage to enter the position. So, those types of things. You need to know the characteristics of your orders, but within the characteristics of those orders, the client should be dealt with in an ethical way, and that's where problems often arise, or not often, but occasionally arise.
Okay. No, I mean, there's usually a lot of stories one hears about retail clients who essentially don't know what they don't know, and through their own ignorance, I guess, they are all too happy to blame the broker, even if the broker might, in the rare event, actually be innocent. But it's always an easy thing to do, just turn around and blame the broker. But I mean, from some of the tricks we've talked about already, David, I mean, would it be fair to say how that's the main way how broker tends to make their money? There is this romanticized image of the broker always profiting from the client's losses. And if the clients are winning clients, then they'll just simply copy his trades. How true is that?
For traders for brokers who are principal license broking firms, they do take the other side of the portfolio, not necessarily against individual traders specifically, although there is the ability to configure yourself in that way, where you do a sort of a targeted approach against individual traders and you risk profile each trader, and you decide whether you want to trade with against them, or for example, or just put them in the general pool and then just hedge at the margin at portfolio level. So there are all types of options there. Taking the other side of the trade is by far and away the most profitable income stream for brokers, because the commissions are, for the most part, relatively smaller, and the overnight funding, if you're at a decent broker, should be a much more smaller percentage of the way in which brokers have earned their money. I think they don't earn interest on client deposits anymore because of the rules that have changed in that regard. So there's primarily those three ways I mentioned which the broker earns their money.
So just to clarify, it's typically the B-book broker that sits the other side of the trade and would make money when the client loses, essentially. Yes. Taking advantage of the reality that the majority of people who aren't trained in currency or trading in general tend to lose their money. Okay, so the broker's not really at a loss really in that sense.
Well, the broker can get it wrong, or they can be on the wrong side of a well-informed larger trader, and occasionally brokers go out of business. So it's not a risk-free proposition seeking to take the other side of a trade. So brokers need to make sure they risk manage carefully.
Sure, and that in itself is going to be quite a delicate process, gauging the skill of their clientele, because they never know who they're up against.
That's right.
On the other
That's
side.
correct.
All right, so moving on now, I mean, is there, talking about the various tricks of the trade, if you like, which some of the less scrupulous brokers engage in, is there such a thing as an ethical broker, David? There must.
Well, I mean, I believe there is such a concept, and I think it's about being as transparent as possible as to the trading conditions, the trading fees, and the risks that you face. It doesn't mean that you will necessarily make money, and you may lose, your entire account, or you might get slipped. All of these things can happen whilst the broker is still actually doing the best that they can for the client. But I mean, in the UK, there are suitability obligations that brokers are required to adhere to when onboarding clients, and they should actually occasionally refuse certain clients and not give them a trading account if they don't know what they're doing. But yes, that is possible.
No, brilliant, because I know, and we'll talk about that later, I mean, what essentially are the hallmarks of an ethical brokerage. Essentially, the opposite of what we talked about, the ones that don't engage in manipulating spreads and things like that. But I mean, what telltale signs, David, should people look out for that their brokerage might be engaging in, dare I say, slightly unscrupulous practices?
Again, well, it's a question of definition. What is unscrupulous? But I mean, I think if you're in a trade and you may have a third-party piece of software that's telling you the market's going up, and then as soon as you go long in size on your broker, the price starts going down, i.e. or the spreads are widening. At that point, you're probably reasonably confident that the broker price is being adjusted to suit the risk position of the book, because they're taking market risk, and that's how they readjust their risk position. So, and I don't think clients ideally would like to have to worry about the noise of the broker readjusting their book, and therefore get stopped out of a trade or not make their money or that they should have made, or or less profit, for example. So that's an important one. And I think all of those practices are related to risk management of your position. You shouldn't front run. It's illegal to front run your clients. So or otherwise manipulate the spreads. I think when people are in a trade, sometimes the spreads widen as soon as you hit the trade. Not for risk management purposes, but just in order to make a larger commission. Some brokers will increase the spread, or the spread might flip from 1 pip to 2 pips as soon as you're in the trade. So you can take some people do that. You can take a view whether you want to be at a broker that changes the spread or doubles the spread habitually, even if the underlying market only moves by 0.1 of a pip up and down in either direction.
Okay. Well, I mean, I do speak to a lot of people who have experienced that at some point in their trading career, but it's quite difficult to prove, really. If you call up a broker, it would be fair to say, unless they're recording the screen, got screenshots, or got some kind of screen software, it's actually quite difficult to prove that to the broker or to the regulator, unless you're quite technically savvy. Do you know any shortcuts, David?
If you're talking about gathering evidence,
Sure.
you can make a request to the broker for information about the trade, and they should be forthcoming with that information. But you probably need to be or persevere to make sure that you get what you need. Whether you do or not, that's a function of who you speak to at the broker and your skill of persuasion. But you should be able to make a request to have information related to your account provided to you. And I think provisions will soon be enforced to allow you to do so, and to also request recorded telephone conversations relating to your account.
No, quite rightly so. I mean, I had a story quite recently, actually, of somebody who had a binary options platform, and they went in for a buy position on cable, and even though the trade went in their direction and the option expired and they should have won, they were actually slipped into the position by 50 pips, which is pretty outrageous, actually. And yeah, they made a fuss, and they got their money back. So it just goes to show that if you are keeping your broker accountable, they could quite happily rule things in your favour, providing you do keep them accountable. I mean, this is where we get somewhat in the realm of conspiracy theory-esque, with regards to some brokers actually having a file on some of the clients who do make a fuss when they're slipped in, and do hold them to accountability. And they leave those clients alone, but they will continue to take advantage of the clients who don't know what they're looking out for.
I mean, I can only speculate that people manage their individual clients in that way. I mean, I can't state with any confidence what happens with other brokers, but it's conceivable that the less vigilant clients will probably not necessarily always get the same service that the ones who hold their brokers to a higher standard receive. Then I don't disagree with that proposition.
Hopefully, people who are listening will be able to arm themselves with information moving forward with their broker. And the irony of this interview is that David is, in fact, a broker, but not just any broker. Atom 8 ticks all sorts of boxes with regards to providing what many other brokers don't. And value for money is certainly one of them, David. Tell me about it.
Thank you, Rob. Yes, no, we are an FCA authorised and regulated broker, which has started in July 2013 with the view of giving people direct market access and direct underlying bank trading conditions. So we do not widen spreads. We do not take the other sides of trade. It's a pure agency model. We just pass your trade through and charge you a commission. Equally, our overnights are multiple times cheaper than the financing costs that other people or other brokers charge you to maintain positions overnight or after the settlement time each night at 10 o'clock. So that's the ethos of our firm. It does rely obviously on traders succeeding and trading in size. So it probably appeals to a more sophisticated or a high net worth audience. But having said that, the conditions are available to all people who meet the minimum deposit requirements for the firm. But we have not had a complaint since the firm commenced, and we treat each client individually, and we try and make sure that they don't have any noise from us, and they just simply are able to match their skills against the market. So we have cheaper commissions for those people who trade more frequently over a monthly period, but on the whole, we try to cover our costs and make a profit, but in a way which is fully disclosed to the client. And as I said, we don't have any temptations, and nor are we allowed to take the other side, and we don't widen spreads or decrease leverage once you're in a trade.
Great. So the difference with you, David, is that the client's success in their trading is ultimately your success, because you don't take the other side of the client's trades. You just make money off the commission, which is extremely reasonable from certainly what I've seen. So you've got everything to gain from the client to having a long and prosperous trading career with you, or using you as their broker rather than simply hoping that they'll just lose all their money like some brokers.
Yes. No. I mean, crucially, there's an alignment of interest between us and the client. So their success is our success. That is clear. And the worst thing possible for us is that someone says, I didn't get a fill on non-farm payrolls, and it must be your fault, and I'm going to withdraw my account. And that's the last thing we want. The reason may be that the underlying liquidity provider in what's called an ECN, withdrew their price, and that can happen, but it's not something that we can control. And I think it's probably worth mentioning the term ECN, which I referred to, which stands for Electronic Communication Networks. What that means is the prices that we can offer you, and which you can see in what's called a market depth window, are the underlying interbank market prices for our particular liquidity pool. So you get allocated by a computer-generated system all of the best bids and offers available in the given size by the pool participants at any given time. So it's entirely transparent, and your commissions are sent to you in a letter when you open your account, so you know your commissions. And you get to see the underlying market price, which most non-ECNs do not provide you. They quote you their price if they, in fact, are a market maker. And so that's what we offer. And it is a story that the clients like, and I think they feel confident with us. And what's important to me is that the firm continues to receive positive feedback from client service perspective, so that we treat our customers fairly at all times, which is actually a regulatory obligation, but this is what we put into practice on a daily basis.
And let's hope your fine efforts end up turning the industry on its head, because there are a lot of bad brokers out there who could certainly learn a thing or two off you, which is a testament to your success. And I just want to ask you, David, for the benefit of people listening, for those who want to get more information about Atomate, where would they be able to find it? So your website is, what is it, www.atom8.com, right?
That's right, atomate.com, that's correct. Or you can call us, which on the number on the contact tab, but I'll give it to you. It's 0207 043 5050 or 5050. So yes, no, we'd be delighted to talk to anyone who wants the right type of trading conditions and assistance with their trading.
Fantastic, David. Well, it's been a pleasure having you on, and thank you very much indeed for your time. And for those of you who are listening, by all means check out Atomate. It's a fantastic brokerage, and I'm also a very happy client.
Thanks very much, Rob.